Hello everyone. Welcome to our first of two videos discussing the PowerPoint slides from chapter 5. So we're actually going to run through the itemized deductions as they appear in the same order as they appear on the Schedule A. You can check that out in Exhibit 5.1 on the second page of chapter 5 in your textbook. So the first one that you've come across is medical and dental expenses. And we'll then we'll do taxes, we'll do interest in this first one, and then we'll go to, in the second one, we'll do charity and casualty losses and some others. So, remember, the total of all of your itemized deductions is beneficial only if it exceeds the standard deduction. So it is either you use itemized deductions, which is what we're talking about here, or you use the standard deduction. And remember, the standard deduction includes the extra standard deduction for age and for being blind. And so you don't want to just compare it to the basic standard deduction. You have to compare it to the basic plus the extra. And only if our itemized deductions exceed that do they benefit us in terms of a tax deduction, if you will. So yes, medical expenses are deductible if together with other itemized deductions they exceed our standard deduction. But let's get into the restrictions specifically on medical expenses. And we're talking about medical expenses, dental expenses, eye exams, all those, really anything to do with that. And here's the first floor that we have in the that we've come across in the tax law. Medical expenses are deductible only to the extent they exceed 7.5 AGI. What does that mean? That means if your AGI is calculated at is $100,000, you don't get to deduct any medical expenses until they exceed 7.5% of that, or $7,500. So if you had $5,000 of medical expenses, they don't help you. They don't reduce. They're not counted. Okay. If you had 8,000 of deductible medical expenses, you would only be able to deduct 500, the amount that you went over that floor of 7.5% of AGI. So you see, when we talked about lowering AGI, that in this case, if your AGI was 100,000 and you had medical expenses of 8,000, then you'd only get a deduction for 500. But if you were able to lower your AGI by 5,000, that would make more of your medical expenses deductible. So that's not only would it have the obvious benefit of lowering your AGI, it would also increase your ability to deduct something else, which in this case, medical expenses. So that's a good example of how all of these rules interact with each other. Okay. Now, so first of all, we can use as medical expenses for ourselves, your spouse, and dependents. Remember, we said dependents and knowing who our dependents are and qualifying as a dependent is an important concept. Well, here's another place where that's important to remember. You can't just pay medical expenses for anyone and have it as a deductible medical expense. It has to be for yourself, your spouse, okay, or dependents. And that has to be exist. You can't create that after the time that you paid the medical bills. So that at the time of the medical bill, there must be that qualifying relationship. So the general rule with medical expenses, and it's quite broad, is that it has to be doctor prescribed. It has to be used to treat a specific illness or condition or injury something like that. It cannot, in general, be just to maintain your general health. So things like going to a gym or having a gym membership is not going to be deductible unless there is such a medical condition that your doctor has prescribed and said you must get certain exercise. Now, typically when that's the case, they're going to send you to physical therapy. So physical therapy, because prescribed, would be a deductible cost of that physical therapy. Okay? But not, and we're talking stuff in your medicine cabinet, the things that are prescribed typically are going to be deductible. Those that are over the counter, as we say, would not be. Now, they have kind of, over the years, expanded the definition of what's prescribed by a doctor to include a lot of health practitioners who may not be MDs. Okay, so there has been cases and situations with a lot of alternative medicine, acupuncture, and things like that, when done by someone that is deemed competent in that situation, and it's to relieve a particular condition, not to just make us feel relaxed. Okay, then we have the potential of being a deductible medical expense. Remember, Congress passes a law and says it's deductible, sets the 7.5% floor and things like that, says the general description, and then the IRS lays out some regulations, but there's no way on earth that they'll consider everything. And so a lot of things you have to look at, and sometimes bigger cases get taken to court, and there has to be discussion about that, and we have to say what was really meant by these rules. Have to be paid, okay? And that doesn't matter what our method of accounting. Remember, and if it's paid by insurance, we obviously shouldn't get a deduction because it didn't cost us anything. So we also have to make sure we consider any health insurance reimbursements or medical expense reimbursements for the care. Now, some sticky places when this comes to us, sometimes there are large expenditures, okay? Especially that you may need to change your house to care for someone with a particular condition. Well, the general idea is, yeah, if that's the reason and you have a prescription from a doctor, you're okay, even though it could be a lot of money. But if it increases the value of your house, then you have to subtract. So you spent $25,000 on this upgrade to your house, but your house is now worth more. Therefore, they're saying you got a benefit from that isn't medical. So some magical way, you're going to have to discern how much that is. And of course, that's a judgment call to a great extent. Okay. But the concept is you put and this you might say is the hot tub rule. If you had a prescription, in theory, that was treating a particular condition, get a hot tub, put it in, spend $10,000. If you could show that your house did not go up in value by $10,000, because if you did, then you're not out anything. But if it didn't, then it only went up $5,000. Then you could deduct the other $5,000, in theory. Okay, so that's the concept. Transportation costs, so driving to and from, taking the bus or train to get surgery or whatever. Okay, you get to drive your car, and you can keep track of various costs of doing that if you so choose. But probably a lot easier is just take the mileage allowance. And that is for 2025, 21 cents per mile. So driving to and from doctors, driving to and from the hospital, for treatment to cancer center, whatever. That could also be deductible. Even staying overnight with some fairly severe restrictions that to $100. But could be important if you went as a parent to be with your child for a surgery or something and had to stay, and there wasn't a place at the hospital or at Ronald McDonald House or something, you had to pay for a hotel. Then you can see how that should be deductible, because there's no way you send a child off to do that without some help. And most people need some help as they get out of surgery, even if they are adults themselves. Premiums for long-term care insurance are deductible, but there's a schedule for how much based on their age. Basically, the idea is, you think of what long-term care insurance, you pay in as insurance, and then if you end up in a nursing home or someplace like that, then the long-term care insurance will pay for your care. Well, basically, the idea of limiting how much is deductible is the idea that when you go into long-term care, some of what you're paying for is medical. I mean, a nurse to be available all the time, come in, give you your meds, things like that. But some of it's just food and such like that you would need to pay anyway. So they don't want to have to fight over that at the time. So they're really looking at, so they limit the long-term care insurance at the time you're paying for the insurance. So, review, the floor is 7.5%. Have to be actually paid only in that year. Okay? You have to reduce it by any insurance reimbursement, and the amount of your long-term care insurance premiums has to be compared to the amount based on age. All right, so obviously it gets more expensive as you get closer to the time you need it versus as you pay for it when you're much younger. All right, jumping into our next list on Schedule A, the next section, if you will, state and local taxes. This is where the big changes came for this for 2025. Several types of taxes are deductible on your federal tax return. Personal property taxes, local real estate taxes. So in Pennsylvania, that'll be your spring taxes and your fall taxes. Okay. Any other special assessments? For a while, we were getting, well, I think we still do get a bill for our hydrants. However, we have to be careful with that, because if that's deemed as increasing the value of our house, then that part of it shouldn't be deductible. But that's it's only $20 anyway, so nobody's going to worry too much about it. State and local income taxes, okay, and foreign taxes. Okay, now state and local taxes is income tax and sales tax, and foreign taxes is the least common. So usually the ones that are most common is, of course, the state and local income tax, and you have to be careful. You may pay those in different ways. You may have some of your local state and local income taxes taken out of your check, right, withheld. And of course, that amount on your W-2 would be deductible for that year under this provision. Now, for 2025, prior to 2025, there was a limit on how much your state and local taxes, the SALT limit at state and local taxes, SALT, SALT limit was, and that includes your property taxes and your state and local income taxes. So the maximum you could deduct, so this was a ceiling. We had a floor on medical expenses. The state and local taxes had a ceiling, meaning you couldn't deduct more than $10,000. No matter how much you paid, it could only be $10,000. Well, 2025 big beautiful bill raised that, okay, to $40,000 for everybody except for married filings separately will be half of that. So that's going to be the rule for through 2030. They didn't make it permanent. Okay, but even that they wrote into it a reduction. So if your AGI is too big, too high, over 500,000, it's going to be your state and local income taxes, even though it's already limited to 40, it's going to get reduced further if you're over 500,000 by 30% of whatever you're over 500,000 till it goes all the way down but it can't go below 10,000. So think about that, okay? So lots of people, especially in high tax states, pay a lot more than 10,000. 40,000, even some of them will be over that, but that will increase a great deal. But if their income is too high, that will start to come back down. But at the end of the day, even if, no matter what their income is, even if it's $1 million, they can still deduct $10,000 just like it was previous. That was the rule, no matter what your income was before. Now that's what will happen again if your income is really high, well over 500,000. So then you're still going to have to deduct at least 10,000. Remember, that includes state and local taxes of all sorts. All right, your income taxes, your real estate taxes, whichever. Now, some rules about your real estate taxes. Personal property tax is really where the rub comes. Okay, but on your real estate, really, you can deduct a tax on as many pieces of property as you own. It is not limited. When we get to interest, we'll see that there's a limit on the amount of debt and things like that. Real estate taxes, your property taxes, you could own property all over the place. And there's no, the only limit is the 40,000 on the last side. But it's not limited to the number of properties or what you use them for. Okay, so it's as many personal use assets as you want. Now, if it's a business use or rental use, you want to do that different place, but we'll get to that later. But as far as any personal, so you could own multiple different properties and deduct all of the taxes on all of them. When we look at personal property taxes, this is fairly rare in Pennsylvania. More common in some other states, but in Pennsylvania, we don't have really personal property taxes. But some states charge your license fee or your amount to license your car based on its value. That's a personal property tax because that's the definition of a personal property. It's based on the value of the property, all right, each year. We don't do that. It's the same regardless of whether you're driving the biggest beater in the world or the most expensive Tesla with your license in Pennsylvania. So none of it is property tax. So none of your license fee or your registration fee, I should say, is deductible under this thing. That's the rub here on personal property taxes. We don't have a lot in Pennsylvania, so you probably don't see it. So when you deduct the state income taxes, remember you could pay that as withholding, taken out of your check, or you can make estimated payments, or you could have paid it when you send in your return because you got it wrong. But you have to be careful, as we've discussed earlier in other chapters. The state tax refund may need to be included as income. If you paid taxes in 1 year and got to deduct it because your taxes and other itemized deductions were higher than the standard deduction, then when you get a refund of that amount, then you have to count it as income. So that's called the tax benefit rule. We dealt with it on the income side. So it makes sense to talk about it once again. Maybe it sounds a little redundant, but it's an easy thing to forget, is that taxable refund. And you just have to, first thing, if they didn't itemize the year before, then clearly there's no tax benefit. They didn't get anything from paying those taxes. So when they get the refund, it shouldn't be income. Now for 2025, you get to choose either your state and local income taxes or your state and local sales tax. All right. Either or, not both. Either or. You can't do both. So in a state where you have income tax, it's almost always the most beneficial. And you want to take the larger, whichever one's going to give you the best deduction. You're going to take your income taxes. So in Pennsylvania, almost always is going to be the income tax. States with no income tax but have sales tax, and I don't know of any state that doesn't have either, I can think of. Maybe New Hampshire. But we'll take the sales tax. Now, sales tax has some shortcuts, you might say, because are you really going to keep track of all the sales tax on all your purchases all year long to try to add it up and say, oh my goodness, look at how much sales tax I paid? No, because that would be hundreds of receipts in a state where, unlike Pennsylvania, perhaps, where you're taxed on food and clothing and all those small purchases, it would be a nightmare to keep track of that. So, shortcut, they said, if you will look at this, kind of schedule and look it up, if you look up somebody's income and you tell them what state they live in, that we'll estimate. We'll give you this IRS will provide you with an estimate that you can of how much tax was probably paid based on what usually people spend on their various things and what's taxable in that state. You can start with that number. To that number, you could add those items where big ticket items. So if you bought a motor home in the year, they're going to charge you sales tax on that. That is going to not be considered in this kind of estimate that the IRS is going to provide you. So, and it wouldn't be that big of a deal to keep your paperwork on that. In fact, you probably should for all kinds of reasons. But you can go back to that paperwork, find the amount of sales tax you paid on that motorhome or on that car or on that tractor or whatever. Add that to the estimate. And so even in states with an income tax, in a year that you made a large purchase like that, it may still be the higher amount to do the sales tax when you add the estimate to these big items that you may have purchased. But you got to make sure you have that paperwork, right, which shouldn't be too hard to make sure you keep. Okay, so this is where it talks about the tax deduction tables provided by the IRS, okay, or the calculator on the IRS website, and put that in and then put it into your software. Typical software will do those calculations for you based on the income and so forth. Now, the last tax situation is foreign taxes can be deductible. However, you have an option. You could take a credit. And we haven't talked about the credits very much yet, but credits reduce your taxable tax liability dollar for dollar. So they are almost always more valuable than a deduction. So in this case, as it says there, you're almost always going to want to take the foreign tax credit. Now there's a few extra hoops you have to go through to do the credit versus the deduction, but it's probably worth it in almost every case. We will return to this topic and the amount of the credit and how to calculate the credit when we get to Chapter 9 about tax credits in general. All right, the last section in this video about, from the Schedule A is interest. So interest paid on a home loan. So it could be the loan you took out to buy the house. It could be the loan home equity loan that you took out to improve the house. Okay, as long as it's secured by your residence, that means that is what the bank will come and get if you don't pay. Okay, but there are some limits. It's deductible on that interest. That's the interest, not the whole payment, just the interest, right? So you can't have debt over $750,000. Okay, so buy a $1.5 million home, you borrow $1.3 million. Part of that's not going to be deductible, only the amount. So you're going to have to figure out how much interest you paid, figure out kind of the percentage that was of it that was under $750 and the percentage that was over, and figure out how much of that interest was deductible. Most of us aren't going to have to worry about that, but occasionally you'll run into a situation where a client or somebody has purchased the house, especially if they have multiple homes. Okay, so there's also a limit that to 2 houses, okay, that you can do this for. So the third house is going to be a problem, and when you start having 2 houses, you may have more than the 750, and more easily can exceed that limit as well. Okay. So the home equity loan, so the original purchase of the house, that loan is fine interest on that. But if you go back and borrow a second mortgage or home equity loan, that interest is only deductible if you use it to either acquire the house. So there's a way you could do it that way, or to improve. That's more likely. Fix it up, not to go on a trip or pay off your credit cards or anything like that. That is no longer. And the commercials that used to try to get you to do that have disappeared as far as claiming deductible interest. Thank heavens, but as this rule has changed. So that really changed in 2018, I should say. Okay, so only if you're going to use it to new roof, kitchen renovation, that sort of thing. It's still subject to the whole total 750 limit as well. So that's added in there. So you could actually go over that limit too with a home equity loan. Now, what did Congress mean? And this is a good situation to kind of illustrate kind of what happens when there's a disagreement in how to apply that. I mean, things like the limit is pretty straightforward. But somebody goes, wait a minute, is this per house, per taxpayer? What's the limit? Okay. So went to court. Court said, okay, apply to unmarried co-owners. So these 2 people aren't married. Okay, so it's actually a benefit for not being married on a per taxpayer basis, not on a per resident. So they could have 1.5 million, right, per person. They each treated as $750,000. So IRS challenged it when they've lost at the appeals court level. They said, and that's what it means by acquiesce. They said, okay, you got us. That's what we won't challenge that anymore. Okay, they have that ability. They could have said, no, we know we're going to lose, at least in the Ninth Circuit, because remember, the circuit courts are based on geography, and it's like, well, yeah, if it happens in California, which is the Ninth Circuit essentially, we'll lose, but we could still win if it's in Kansas or someplace else, because that's a different circuit, and that court may choose. We think we might can win them over with our argument. This says, well, no, we're not going to play that game. We lost. We're going to just say, okay, that's how we'll treat it. Other things having to do with interest you might run into: points. These are prepaid interest at the beginning of a loan. The general rule is that it's prepaid and it can only be deducted over the life of the loan. So if you paid that extra $10,000, as it says there, you would deduct it a little bit over the 30-year loan or the 15-year loan. However, our tax law says, in the case of your personal residence, and if you pay for points, we'll give you a break because we want to encourage home ownership. We want to make it a little easier for people to buy houses. And so we'll let you, if this is your personal primary residence, we'll let you deduct the points all in the year that you close on the house. Okay? So that's a kind of a break. As we wrap this up, the topic of investment interest. And what this is say you borrow money to make an investment. Not buy a house, okay, that's what we've been talking about, but this is to buy stock. So you can go to Charles Schwab, you can go to a broker, you can borrow money and buy stock. Okay? Now, of course, you're going to have to pay interest on that loan. Well, is that interest deductible? And the answer is maybe. Okay? It is deductible to the extent that your investment made money. Now, technically, you can use income from one investment to qualify another investment, but let's just go with the idea that you've got to have some income. And that income can't be that just the stock went up in value, because that's not income until you sell it. So you'd have to have sold the stock for you to have income. If you're just owning the stock and it's not paying you dividends and it's not going up in value, but you're still paying interest on the loan you took out to buy the stock, that investment interest is not deductible because there is no income. So it's limited to the income you made from the investments. And if you can't deduct it in the current year, you have to use it. You can carry it forward and use it in future years. Okay, but it's not going to help you this year. So you need to be sure that there's income that is sufficient to allow you to deduct that. And if your income is $1,000, but you paid interest of $2,000, then only half of it would be deductible. And then again, that half of it would be added in with all the other interest, all the other taxes, all the other medical expenses, based on individual limits on each one of them, to see if that total compared to your standard deduction was higher.